Hello, my name is Jerry Yu. Thank you for watching my YouTube channel. Please click the like and subscribe button. This will help me tremendously with the YouTube algorithm. As you know, one of the major benefits of annuity is that by contract, insurance company will pay you income for the rest of your life, regardless you live to age 80 or age 120. Many of my clients and workshop attendees have always puzzled on how can insurance company make money with annuity if they have to pay all these policies. You will be surprised that majority of the insurance agents do not know this information. I'm here to clarify the myth, misunderstanding, and provide transparency and truth that you deserve to know. There's no secret. How do we get here to begin with? Truth be told, insurance companies are making a boatload of money. Record sales on the top line and record profit on the bottom line. See, they are doing that through the combination of two external factors. One is the stock market volatility that we have continued to experience, along with the combination of rising interest rate. When that occurs, you are seeing a large influx of money leaving the stock market and enter the insurance industry, where insurance companies can manufacture products such as annuities to provide fixed rate, guarantees, and peace of mind. While some people might not like the insurance company are making more money, what's new, right? But I'm here to share with you that it's actually a good news. We want the insurance company to profit because that's going to translate into more money inside your pocket. Let's look over here on the board. And I have an example of what would happen and how a company make profit on the $100,000 that you give them and what they do with it. In this example, you have $100,000 that's going to give it to the insurance company. This is a great opportunity to show you how safe insurance companies are when they take your money, because they use what's called an interest rate spread. That's different than bank, where banks are leveraged to generate returns. So if you give the bank $10,000, they're only required to show $1,000 on their balance sheet as they leverage the rest. And we're going to show you how insurance companies take more of the safer approach and have higher reserve requirement are essentially the reason why insurance companies are considered the backbone to the American financial system. In this example, we're buying $100,000 of an index annuity. There are different types of annuities out there. Well, we're using an index annuity due to their popularity. As I mentioned, that $100,000 is immediately deposited in what's called a general account. That general account is going to yield a 5% return. Okay? That 5% is going to come from highly saved liquid instruments, such as bond, corporate bond, muni bond, or treasury bonds, or some exposure to equity via stock, cash, mortgages, or insurance company are good. And they're doing this with billions of dollars, which is going to generate right now in today's market about a 5% risk-free return. That 5% is going to yield a $5,000 a month, but don't be too happy yet. But that $5,000 is not going to be credited to your policy. This is where the interest rate spread over the technique insurance company use to make money is then applied. First and foremost, they're taking part of that $5,000 for their overhead, which is going to build into their profit. Insurance companies are a brick and mortar company. They need to keep the lights on. So they are going to take out what they need to continue to run their business. Second part is what is considered a financial advisor compensation. Insurance companies need the distribution system to sell their product. Also want to make sure the financial advisor continue to provide client services year after year, like the annual review. Now we have close to 1.5% of the spread from the original dollar amount that we're giving them. And this is taking out from this $5,000 in return. And what happened next? Okay, so we are left with $3,500. This is a fixed annuity. That's a 3.5% guarantee rate applied to your policy. Since we're using an index annuity, what's going to happen next is an insurance company is going to take this $3,500 and they're going to purchase options, which is going to provide us some of the upside potential, typically tied to an external index such as S&P 500, which is going to give us a 10% cap, for example. The key feature of index annuity is the client will always have a floor of never losing money, but client also has the upside potential of earning a 10% return based on this example. See, we don't know exactly what's going to transpire in terms of the return projected 12 months from now, but what's going to give the policyholder a credit at the end of the year. Now, what happens if the index actual return is negative? And those options that insurance company purchased will expire worthless. And we have insurance companies' general account to fall back on and providing us that 0% floor protection. Here are a couple of things that we talked about earlier today. We talk about what happened when insurance company receive your dollar and how that's going to go into a general account yielding at 5%. And we know that indirectly we are paying the advisor and we are giving the insurance company some profit. So they continue to run their operations, and what's left over, or that net amount, is what's used to purchase options, which is going to provide you that upside interest potential. Hopefully, after watching this episode, you're able to understand what happened when the money gets put inside the general account and how it can provide you return and lifetime income. If you like today's content, please make sure to hit the like and subscribe button, and I will see you in future episodes. Thank you for watching.